My name is Jake, welcome to the channel. In today's video, we're going to do a Review My Pie video where I review subscriber portfolios. I've been doing this for a couple of years now. I really enjoy it. I learn something new every single time I review somebody's portfolio. It just kind of opens my eyes to maybe new things that I've never thought of before, or it's just kind of like spying on other people. It's like, oh, that's cool. How are they doing that? Or, looking at it from maybe another person's, point of view. If you're a longtime subscriber of the channel, you probably are telling a difference in my voice. That is because I just tested positive for the Rona. I was on a work trip here the last couple of days here this last week. I was over in Copenhagen and I came back and my throat was hurting. I had a headache, had a cough, and I'm just like, oh man, no. I've gone 2.5 years without getting it, but it finally got me. It finally got me. I felt like Neo here in the Matrix these last couple of years where I have not, gotten it. I haven't had any symptoms. And I most definitely have it now. So I apologize if I'm sniffling or coughing here. I'll do my best. It's probably going to take me like triple the time here to edit this video because of all the coughing and the mucus noises. So I'll spare you by editing all of those out. That'll be fun. But anyways, yeah, so today's video, we're going to do the Review My Pie. In terms of my portfolio, no really big updates, just more red in the market. So, just normal stuff, but yeah. So like always, what we're going to do is we're going to answer a subscriber question here, and then we're going to review 3 portfolios. The first is going to be from a 23-year-old here in the United States, the second a 21-year-old from Belarus, and then the third a 40-year-old from the US. The timestamps will be in the description below, as well as the portfolio links. And as always, everybody, I'm not a financial advisor. Don't take what I'm saying as financial advice. It's just merely for your entertainment. And as always, I don't pre-record or look at the portfolios in advance. So I'm reviewing them for the very first time, trying to make it as authentic as I possibly can. But I think it's very, very important that before we dive into the video that we address a very important topic here. So I read all of your comments and I really enjoy reading your comments, but every once in a while, there's a comment that sticks out and it just like makes me think. And so there was a comment made on my last video here by Sermonator89. And so Sermonator, you said that my meme game was getting a little bit weak and that if I had a summer slump. You know what I have to say about that, Sermonator89? Well, I wouldn't consider myself a professional financial advisor, but I would consider myself a professional memer. And so with that, Sermonator89, my response looks a little like this.
Hey, buddy, I'm not paying you to hear your thoughts on life. I'm paying you to sing.
Well, I have a microphone, and you don't.
So you will listen to every damn word I have to say! You are the worst wedding singer in the world, buddy.
Sir, one more outburst, I will strangle you with my microphone wire. You understand me?
Oh my gosh. I may have the Rona, but I can still dunk on you, Sermonator89. He's been commenting on my channel for like the last 2 years. So shout out to you, man. Appreciate it. All right, so let's get into the first question here. So the first question is, hi Jake, love the channel. I'm a huge fan and have gotten hooked on long-term dividend investing during the pandemic. Well, first off, Nate here, appreciate the kind words. You continue writing here. I built a decent portfolio in just 2 years, but today I would like to ask a question about the best plan for my parents. Last year, my parents sold their house at the top of the market. This was a godsend, but my dad's health deteriorated and he is no longer able to work. He never invested and is constantly in and out of the hospital with a very serious complication stemming from a previous battle with a stomach cancer. Due to this tricky financial situation, my mom wants to invest the money they got from the house sale to provide some source of income. What pie would you recommend for someone with $250K who needs to live off dividends now? I know it's not an ideal amount, but could it at least provide enough income for them to live meagerly with their Social Security? I was thinking of recommending she put half in SCHD and the other half in JEPI to get a 5.44% return on their money while staying relatively diversified. When you say return, I'm assuming you're talking about the dividend there, because the dividend is just part of the return. You keep writing here, please let me know what you think is a good plan, or if you think there's better stocks to invest in for higher immediate dividends that will stay strong in a volatile market. Thanks for your knowledge you share on your channel. Take care and have an awesome week. Regards, Nate. Well, Nate, first off, thanks for the message here, and I'm sorry to hear about your dad. And it sounds like things could be much worse is what it sounds like. You have Social Security, or your parents have access to Social Security. They do have $250,000 that they can now invest. And it's just a matter of what is the right approach. So your parents probably, you don't mention how old they are, but the thing that you want to balance here, when you're looking to live off the money today, you want to make sure that you're planning not only for the short term, but for the long term. Right? Now, if they are in their 80s, the answer is going to be very different than if they're maybe in their early or mid 60s. Okay. With life expectancy of people, of human beings older and older, it kind of changes the way that we perceive this. But I guess the way that I would say it is, you want to focus, or if I was in your shoes, or if I was having this conversation with my parents, it would be, okay, well, they worked hard for this money. We want to make sure that we set them up for success. And so I do like focusing on ETFs and not individual stocks. I think you don't want to be emotional when it comes to this type of investments, that you take here. So I think shying away from individual stocks is probably a good idea, and just sticking with ETFs. So that's the first thing. I do like that. But really what it comes down to is just math. You have the money today. Now let's make that money work to your goal, okay? And in order to do that, let's go ahead and let's take a look at a weighted average calculator, and I'll walk you through some ideas here. So what we're going to do is we're going to look at a weighted average calculator. Now you can Google this, and either this website or another one will come up. And ideally what you want to do is you want to understand, okay, well, how much income do I need in order to generate the amount of annual dividends that I'm looking for, right? And so what we're going to do is we're going to work a little bit backwards. And so you mentioned JEPI and SCHD, but what I would do is I would say, okay, well, how much dividend income do you ideally want or need today? And then the next thing that you want to think about is, well, how much do I want that to grow over time? And that should be a factor as well. Okay, so let's take out our calculator here and let's take a look at this for an example. Let's say you said they have Social Security, but they're looking for extra income. Let's say they want $12,000 a year, so $1,000 per month, that they can have on top of their Social Security to pay for their living expenses. Now, let's say, for example, how much money do we need in order to get $12,000? Well, the question really is well, what investment? It depends on the interest rate. So you said a 5.44. So let's divide 12,000 by 544. That means you would need $220,000. So your approach that you just said would get you around $1,000 a month. And I think that's a really, really good amount. But if you're saying, well, Jake, I need a lot more than $12,000. I actually need, $20,000. Well, that changes things, and let's take a look at how that would look. So if we needed $20,000 divided by the same portfolio mix, that means you would need $367,000. You don't have that. You have the 250. So then what we need to do is we need to reassess this 5.44%. So let's do, for example, let's say we want still the $20,000. Let's divide by, let's say 8%. 8%, $250,000. So in order to get $20,000, you would need an 8% dividend yield. Okay. Now you're not going to be able to buy Coca-Cola in order to get that, right? As an example. So something that you could do is think, all right, well, how can I get that 8%? There's different levers that you can pull here. You either need to increase the dividend yield and thereby, essentially maybe increase the risk return when it comes to the investments that you're choosing there. or you need to lower the expectation or the expected dividend income. What is $20,000 here per month? That's like, just under $1,700. So that's the question that you have to answer for yourself and say, okay, do I need $1,000 a month? Do I need $1,500 a month? Do I need $1,200 a month? And then what you need to do is you need to figure out, okay, well, what mixture, what blend of investments are going to give me the desired dividend yield? Okay, and if you have more than one ETF, then you're going to have a weighted average. And that's why this weighted average calculator is so important. Let's say, for example, you did 50% in SCHD. Let's say you did 25% in JEPI, and let's say you did 25% in a cover call ETF like QYLD as an example, right? Let's say SCHD is yielding just under 3.5%, JEPI is yielding just under 9%, and QYLD is yielding just around 14%. Now, I'm not advocating for this ETF or any of this. I'm just trying to understand what is the weighted average. So here, you're getting, with this portfolio mix, the weighted average is 7.5%. So if you got the 250,000 times 0.075, that means you're going to get just under 19,000, which is going to give you, $1,500 a month. Now, if you're saying, well, Jake, I don't want cover call ETFs, or, maybe not QYLD. Let's say, for example, maybe you want an ETF or something else that yields 4.5%, maybe like a realty income, like a REIT that pays monthly, or an ETF that's 4.5%. It doesn't matter. Just humor me here for a second. If you do that, you're going to have a lower yield, okay? And then if you're saying, for example, well, no, we really need that $20,000, well, then it just is a matter of setting up the portfolio in a way that gives you this desired weighted average in terms of the dividend yield. And then you can enter that into the calculator if you have the money today, if you were to purchase today, what that would amount to. And so that is how you do that. Now, I want to take it one step further, and I want to go into the dividend reinvestment calculator. I will leave this link in the pinned comment below. There's a tab in this calculator, in this spreadsheet here, that says living off of your portfolio today. So then what we're going to do is we're going to take this 2 million and we're going to do 250,000. And let's say you have a weighted average of, 5%, 5%, and 5%. Now, just if you've seen this calculator for the very first time, I would read through the instructions here and see how I'm getting these numbers. But if you have a portfolio that is still growing, like SCHD, JEPI combined are still going to be growing over time. And so, but you're not reinvesting the dividend and you're not adding more capital, what is the portfolio going to generate in terms of annual dividend income over time? And that's what this is looking at right here. And so I have other sheets that focus on, DRIP and all that, but this is just for living off a portfolio today. Let's pull this over and let's see what this looks like. So if you were to do something like SCHD and JEPI, for example, you would have something roughly like this. But here's the cool thing. Even though you're not dripping the dividend and you're not adding more to the portfolio, your parents, if they invest into something similar to this, they're going to have in the first year, just over $12,000 in dividend income. After 10 years, without dripping or adding any additional investments, they're going to have just under 20,000. And then after 15 years, 25,000. And so it's going to be growing slower, had you reinvested the dividend and dollar cost averaged into the portfolio. But the thing here is, this is what you want to model when you're looking at the investment. You want to make sure that it's still continuing to grow. And let's take, for example, if we were to say this was 8% and this was 3% and this was 3%, right? What would that look like, right? And you can play with the numbers here, but when you're factoring this in and thinking about this, this is how you do that. And sometimes it's not just about finding the right investment. It's about what is your risk tolerance? What is your ideal goal? What is your plans with the money? What is your purpose behind it? Why are you investing it? And if you can work backwards, then you can really, and this goes for everyone, whether it's for your parents or for you, if you can figure this out and make the math work for you and understand the levers that you have available to you, that's how you make this work. And once you figure this out and you have that light bulb, it's an incredible feeling. So I hope that this is helpful. I hope that this helps you in, thinking about this for your parents or for you if you're watching this or somebody else, but this is how you calculate that. All right, let's take a look at the first portfolio here from Sam. Sam writes, "Hi, I am 23 years old, making $150,000 for my salary plus part-time work as a software engineer. Each paycheck, $450 goes into a traditional 401k, $450 goes into my Roth 401k, and 50% goes straight to my brokerage account, and the rest goes to my brokerage, where I decide to add more to my brokerage based off of my spending that month." Wow, this is incredible. My 401k is 95% stocks, 5 bonds, automatically determined by the company managing it. I will max it out every year. It currently has $15,000. My Roth IRA is worth about $27,000 due to the crashing recently. It's been maxed through 2022, so I still have the option to add my 6K for 2023. Though I may be unable to invest normally into the Roth due to my income, I'll have to try a backdoor Roth IRA. Okay, well, great. So it sounds like you got some first world problems here. That's great. The backdoor Roth IRA is a great option here. So it looks like you have only ETFs. This is your tax advantaged accounts. You have a lot of different things in here. Like, this is a lot. Like, you got a small cap, you got a value, you got a large cap. So to be very honest, Sam, when you're 23, when I first started doing this, I did a similar approach. You know what I ended up doing? Because I changed jobs a couple of times early on in my career, I ended up selling a lot of my holdings. And what I noticed is it was just so complicated. Unless you're going to work at the same company for the next 10, 20, 30 years or whatever, I would just recommend making it simple. So for example, I'll share what I did. I had a similar approach when I first started, and I then had to liquidate everything. And the majority of the stuff that I liquidated, I actually sold at a loss. And so what I decided was, well, shoot, I'm in a career where I'm constantly changing jobs. And so I just decided to invest everything into the S&P 500 and make it super easy. And lo and behold, since I've done that, I've changed jobs like 3 times since then. And so if you're in a career, in a job where you're going to stay for the next 10 years, I think this is great. But if you're going to be changing jobs, in my experience, it was just super easy to just pick one fund, one index fund, and call it a day. But to everyone their own, I think this can work. But the more you touch your portfolio here, the more you try to over-engineer it, usually the more diminishing returns you're going to have. So I guess what I would say to this is keep it simple. If you have access to like a VTI or S&P 500 or a total world ETF or index fund, I would suggest something like that. But all in all, there's nothing wrong with this. I just think it's just easier to make it simpler. I think there's an easier way to do it. But nothing wrong with it necessarily. My brokerage has about $29,000. I'm investing about $4,500 a month going forward. However, some may be taken out. I invest about 10% of UIM, 10% SHD, and even split following the stocks. Oh, you do an even split. So you do something very similar to me, actually. So I do something this is very similar to my portfolio in terms of the strategy. I'm heavily indexed into VYM and SEHD, but I evenly allocate to my holdings. I actually like that. Okay, so let's take a look in your portfolio. So we're not able to see the historical performance here for whatever reason. I do love the low expense ratio. You have a good dividend yield. 3% is actually on the higher end. You're a software engineer. You're making a lot of money. You may have a shorter time horizon. If your time horizon is longer than 10 years, I would try to lower this, try to get a little bit lower, because you are in a high tax bracket. You're going to be paying taxes on this, and that's not something that you ideally want to do. So you didn't tell me your time horizon, But if you have over 10 years, I would reevaluate this and see if you can get this down a little bit lower. It's a little bit higher. If you have, 5 to 10 years, I think this is wonderful. I think this is really, really good. This is like so similar to mine. This is funny. All right, cool. So you got VYM. I like it. I like it. I like that you don't have cover call ETFs in here, by the way. So you're 23. You don't, unless you are going to be retiring early or living off your portfolio in the next couple of years, don't go with these cover call ETFs like I do. Like, I don't recommend it. It's just not ideal if you have a longer term time horizon. You have some great companies in here. You got Kroger, Pepsi, Realty Income. A lot of these companies, they're consumer facing, so you probably use them as a consumer. You probably fill up your truck or your car at Chevron, probably go bulk shopping at Costco. I mean, you're 23, so how much bulk shopping are you doing? I don't know, but AbbVie, 3M, well, I'm feeling the pain with 3M. We'll see what goes on there. Coca-Cola, AT&T, yeah. A lot of big companies in here. I guess I like it. I actually really, really like this. The last thing that I would say here is, go through each one of your holdings and ask the question, do you know how Target makes money? Do you know how T. Rowe makes money? Do you know how, understand the business model of these companies? And if you can't answer those questions of how they make money and how they do well in good economic times and bad economic times, you may want to do a little bit more research, but you got some really, really, really great companies in here. So I think this is a very conservative portfolio. It may be too conservative for you as a 23-year-old, but once again, time horizon really dictates how you invest, not your age. You may be one of the very few that retires at the age of 30. And if you're looking to reach fire at the age of 30, this is a rock solid portfolio that's going to help you get there. Now, if you're somebody that wants to retire in their 50s or late 40s, you got some researching to do here because this portfolio is not set up ideal for longer than 10 years. Okay, so that's the feedback there. Everyone watching, this is a great strategy if you have the ideal time horizon in the next 10 years. Over 10 years, probably not the best fit. And if you don't understand what I'm saying with that, go on my channel and watch the videos that I've made around time horizon, and that will all make sense. So Sam, thank you so much for sending over your portfolio. All right, the next portfolio is from Max. He writes, "Hi, my name is Max, and I'm a young software engineer." Oh, another software engineer. From Belarus, 21 years old, and I invest around a year. Okay, have 16K stock portfolio, $350 in dividends per year, and plan to retire at the age of 35 to 40, so in about 15 years, with target dividend income of 68K. 68K US dollars in Belarus, man, you're going to be living like a king. That is incredible. I plan to relocate to Scandinavia. Okay, there it is. If you're going to move to Scandinavia, you may need a little bit more than 68K. I was just in Scandinavia. Got the Rona there. Anyways, who knows? I don't know. Okay, anyways, let's go over this again. I plan to relocate to Scandinavia soon and reach fire there. After reaching fire, I dream of traveling the world and becoming a full-time dad and do some things besides family for myself. Isn't that so cool? Right? Like you got like a Gen, what is he? Gen Y? Gen Y? Gen Z? I don't know. One of those. Thinking about fire and being a full-time dad. Isn't that incredible? How things have changed. This is so great. I tried, okay, so what do we got here? So let's take a look at your portfolio. My asset allocation is 100% US assets, 70% into SCHD, and 25% dividend stocks and are these two guys like twins or something? This is like so similar in terms of the percentages. I love this. I absolutely love this because you don't know, Max, do you know if Broadcom or Home Depot is gonna do better than Domino's? I think that's Domino. Oh, I'm such a freaking nerd. I know the ticker symbols by heart, even though I don't invest in Domino's or Starbucks or Best Buy. I'm such a nerd. Who else knows like what these companies are? AbbVie, Broadcom, Texas Instruments, Home Depot, Best Buy, Starbucks, Domino's. Oh man, we're nerds. And then you got BST. This is a closed-end fund focused on technology. Okay, cool. So You got the dividend CAGR, the dividend yield. What else do you got in here? Okay, would also like to do something in portfolio in the future. Would I add or change anything? Okay, let me go back up here and look at this. So you have the plan to retire in, let's say conservatively 40. So 20 years. You have a 20-year time horizon. You got SHD and you got these. Let me do some math here. The Rona's making my brain a little bit slow. So how many you got in here? 1, 2, 3, 4, 5, 6, 7. 25 divided by 7. 3.5% is fine. Okay, so you don't have more than 5% in one company. I like that. I think 70% in SHD is a little bit high. I personally wouldn't do that. I'm a little bit risk averse. I don't like, I mean, SHD is amazing. I would maybe consider, maybe there's another one like VYM or DGRO or another one. I'm just, unless it's like the S&P 500 or total US stock market ETF like VTI, I'm not a big fan of only going really, really big into one dividend ETF. I'm just a little bit more risk averse than that. So I guess when it comes to this, man, you are in such an amazing position. You have a clear goal, right? Your goal is the 68K. You may want to consider bumping that up a little bit. And so here's the thing that you have to understand. You have to understand how inflation is going to eat away at this over the next 20 years. Go on Google and look at an inflation calculator and project at 2 or 3% and what your purchasing power is going to be in 20 years. You may find out that you actually need a little bit more in Scandinavia. Now in Belarus, you could probably get away with it, or maybe in another lower cost of living area. But I would definitely take a look at a inflation calculator. That's the first thing that I would do. I would reconsider your allocation so heavy in one dividend ETF. I love the ETF, but maybe diversify a little bit more, because SEHD, there's 100 companies in this index, which is great, but maybe you could get a little bit more diversified. I don't know, just an idea there. And I like that you don't have too many companies. I think that's really good. But yeah, that's really the things that I would focus on. And here's the last thing, and I don't talk a lot about this, but you're 21 years old. Make sure you make time to have fun. Right? One of the things that I don't regret in my 20s, I found fire in my, early 30s. I don't regret going on vacation when I was in my 20s. I don't regret having fun. I would make sure if you're 21 years old, make sure that you also enjoy life and that you don't go too crazy about this whole fire. Fire is an amazing thing. But in your 20s, make sure that you still make time to have fun. You're a high earner. You're in a high stress career. Make sure that you still make time to have fun. Okay? Because that's one of the things I don't regret going to Prague. I don't regret going to Vienna. I don't regret going to Thailand or anything like that in my 20s. Make sure that you think about that as well and plan financially so that you can have those experiences as well. So Max, thank you so much for sending over your portfolio here. It's great to hear that a software engineer all the way across the pond in Belarus is following the channel. Thank you so much. Appreciate it. Let's take a look at the last portfolio here from Josh. He writes, "Hey Jake, I'd love some criticism or reassurance or whatever you have on my current strategy. If you will, here's a simulation on my Roth." Why are you sending me like a novel and email when I got Rona and I can hardly talk, Josh? You're killing me, man. Oh my gosh. I'll do my best. Let's see if I can read this here. This novel of an email you sent here. I'm just messing. Let's see here. So my name is Josh and I'm currently 40 years old, living in the US. I have to point out that I don't own Costco. That's a placeholder because my M1 Finance doesn't have LSPK and others, and all the percentages are accurate. I make use of the 4% yield, 10% growth rate strategy. I'm going to scoop in 30 years. Currently, I'm showing 14% 5-year dividend growth rate. So the dividend CAGR, 4% dividend yield. That's actually really good. 14% dividend CAGR with a 4% dividend yield. Are you like a wizard, Harry, or what? That is incredible. I'm maxing out the Roth, and if I can swing it, I'm going to pick up an HSA next year and treat it as a Roth extension with the same pie. Very good, my man. This is the way you do it. Great. For my taxable account, I have all kinds of random stuff in there since I just started investing last year, but I'm cutting it all down just 50% VGT, and I don't know what this one is. I chose over VTSX. Oh, is it a total US index one? Okay. The only other thing I'm going to keep is AMD, 50% in VGT. Okay, so yeah, all right, cool, that's fine. I mean, it's pretty heavy in technology, but yeah, okay. It really depends on your time horizon. If you have less than 10 years, this is probably a little bit riskier than I personally would take. This would be great if, in 2009, but I don't know what the next 10 years are going to look like. I'm not going to pretend like I do, but interesting. Okay, small position in AMD. All right, so you keep writing here. My goal for the taxable 50/50 is $1,500 a month for 15 years, which according to backtest will get me to just over 1.2 million. Not sure if the market will cooperate this decade, at which point I will sell out and pick up some dividend stocks, mostly like the trio SEHD, XYLD, and Devo. Okay, SEHD is good. XYLD is the S&P 500 cover call ETF from Global X, and then Devo is a cover call ETF, but also it's focused on growth as well, which is cool. My main question is, am I crazy and or foolish for assuming a 15-year time horizon will reach my target of 1.2 million? And should I even bother with growth or just stick with dividends from the beginning? Thank you so much for reading all this. With the market as it is, I'm pretty confident in my dividend setup, but less so about the taxable account, and would appreciate a little bit of guidance. Okay, so I guess, understanding that you don't have a crystal ball, I don't have a crystal ball, this is what makes this so difficult. The last 10 years have been incredible for the stock market. Who's to say that the next 10 won't be? I think, in my opinion, what I'm trying to do is focus on what I can control. So what can I control? I can control my expenses. I can control staying out of debt. I can control, how much I'm spending on discretionary items, how much I'm traveling. I can, for the most part, control where I work, how much money I make within reason, right? If I'm not happy with where I'm working, I go somewhere else and I work somewhere else. Now, I understand not everybody is able to do that, but I would focus on things that you can control. The type of investments that you invest in really should be the second thing that you look at. It shouldn't be the first thing. Most people think that they just have to hit it big and they just have to pick the right stock or the right ETF. That's only part of it. The big thing that you really have to focus on is everything else that is maybe a little bit more common sense. It's making sure that you're not spending more money than you have. It's getting your financial literacy under control, automating your investing. Like, those are the simple things that you really want to focus on. And then after you do that, then you just understand compound rates, play around with a dividend calculator, and then forecast with the numbers. At the end of the day, the numbers are just numbers, and you make them work to your benefit. But what I would recommend you do is not try to plan this perfectly, because you may reach your goal in 15 years, you may reach it in 7, you may reach it in 25. And so if you understand that, then just focus on the things that you control, stick with quality. Don't always try to shoot for the moon, right? That's really at a high level what I would say to you and what I would say to everyone. Don't overcomplicate it too much and stick with quality. So this is in your Roth account. Let's see, the thing is not working here. Let's see what you got. 0 expenses, so no ETFs. High dividend yield. You're 40 years old. A lot of these companies, okay, I don't see a lot of these companies all the time. Okay. So let me just share my opinion. Now, overall, I think a lot of these companies are fine. American Tower is great. I own it. Illinois Toolworks, great company. Costco, great company. AbbVie, great company. A lot of these are really good companies. The question is how hands-on do you want to be with this portfolio? You said you're 40 years old, so you have 15 years before you're going to use this. 15 years is a long time. Do you know, like, in 7% in Best Buy? I used to work at Circuit City that went bankrupt. Could you imagine if something happened and Best Buy all of a sudden went bankrupt? 7%? Let's say, for example, American Tower, they had a scandal and they also went bankrupt. And then that was another 7% gone. I'm not saying that they are, but just like, for me, it's a little bit riskier than more risk than I would like to take on. This is a Roth account. It should be on autopilot, in my opinion. And that's why in my Roth IRA, I only own ETFs. I don't own individual companies because I don't know what the future is going to hold. I don't know which company is going to disrupt another company, what industry is going to get disrupted or whatever. And I don't even claim to think that I do. Now, I'm only saying that because I know that there's a lot of people watching my channel that are experienced and those that are not experienced. And so I would always say, take the most, in my opinion, if you have a long-term time horizon, invest in what you know. And if you know these companies and if you believe in them, if you understand them, I think this is the right approach for you. But I think most people watching my channel, this is the wrong approach, in that you should really consider lowering your exposure to individual stocks and stick with a broad-based ETF or index fund. Now, you can have that focused on dividends like SEHD, for example, or DGRO, I love them, or VYM. Or you could go with VGT, for example, like you mentioned in your ETF, and get exposure that way. But I think just having individual companies in your Roth IRA, and that being your sole focus here, I think you're going to limit your exposure in the market, and you're going to have a lot of missed opportunities because you and I, no one knows what the future will hold. And by doing this, by investing this way, you're saying you know more than the market. You're saying that this company is going to do better than the underlying index. And I don't think anybody knows that. And so that's why I would consider maybe consider adding an ETF or an index fund that tracks the broader market that could maybe cushion your portfolio over the next 15 years so that you can get exposure to maybe pockets of the market that are outperforming that you could have maybe never seen coming. So that's with your Roth IRA. But when it comes to your plan with the taxable account and the $1,500 per month, once again, I think, SEHD is good. I love SEHD. What it really comes down to is with those for the next 15 years, don't look at those cover call ETFs yet. You could always add them later. Look at the numbers, do the math, kind of re-engineer and see how the math is going to work for you, and then, once again, focus on what you can control. And then from there, just putting it all together, and you should be able to set yourself up for success, because honestly, in the next 15 years, no one knows what the market is in the world and the economy, what things are going to look like. So that's how I would respond to that. So thank you so much for sending over your portfolio. Thank you so much for watching, everybody. I appreciate you sticking through the video. If you made it to the end of the video, I apologize for the scratchy voice here. Hopefully here next week I'll be feeling better. But yeah, thanks for watching. I hope that you learned something new, and I'll see everybody in next week's video. We'll see you.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.